Steve Englander, Global Head of G10 FX Research and North America Macro Strategy at Standard Chartered Bank, joining us this morning. Steve, great to speak with you always. Thank you so much for your time. On a scale of 1 to 10, and let me phrase this question best I can. On a scale of 1 to 10, how serious do you think Trump is on actually going ahead with everything he's stating on tariffs?
If you put the emphasis on everything, I'd say 2.
Okay.
If you put the emphasis on some of it, I'd say 7 or 8. So, I don't think he's ever going to do everything he says. It would do a lot of damage to American industry, and I'm sure he's getting an earful from companies that trade with Canada and Mexico because production's very integrated. But I think that he intends to do something. And, Europe is going to be the next target. Ultimately, India will be a target, but, I don't think it's got the same priorities that Europe and Canada and Mexico and China have right now.
Okay, so having said that, just on the point of recession, because that's the big talk right now, various theories out there. One of the theories, and maybe that's a bit far out, is that the Trump administration is okay with some recessionary signs because they look at this as the great cleanup of the American economy. They're deep in debt. They don't want to kick the can down the road. They know that there's going to be short-term pain, and they're okay with it. Do you think that's what's going on, or there's no real thought to what's going on?
I would say if only that was the logic and the hope. I think from their perspective that if there's a negative quarter in GDP in Q1, it's Biden's fault. And if they talk a little bearish in terms of the economy, and it turns out that the economy does better than expected, then they'll get the credit and they'll be fine. I don't think that they'll be as casual about talking about recession in Q2 and Q3. I think they're okay with kind of weakness in Q1 because they won't be carrying the can on that one.
Steve, good morning. Hiral on this side. To this, how do you see Fed responding to this? Do you think they will go ahead and increase rates again, threatening to slow economic growth? Or will it cut rates to stimulate growth? Because then it'll potentially allow inflation to then increase.
I think in the short term, they're going to be guided by what the economy is doing. We're not going to get stimulus from, fiscal policy and certainly not from trade policy. The fiscal, stimulus will likely come in Q2, probably late in Q3, maybe Q4. So if the economy looks soft, then it doesn't have to be a recession. It just has to be soft, and we expect inflation to turn down. There's nothing wrong with cutting, but I think they'll make it clear that, they're cutting because the economy is soft. But, if it turns out that there's inflationary pressures that emerge or that the economy looks like it's overheating, either on its own or because of fiscal stimulus, then they'll hike again. I don't think they'll be hung up on the idea that you can't cut for you can't cut today and take it back in 6 months. I think that they'll be perfectly fine with that.
Steve, good evening to you. The euro is now really, really wrapping up against the dollar. To your mind, which is the most important currency combination to look at? Because while the dollar index is also at 103.5, there is a lot of intercurrency permutations and combinations that might be more important. To your mind, what is it that you would watch out for the most?
Well, I think it's, euro is still the number 2 currency. And so you have to pay attention to it. It does have coattails for most other currencies. And you can see year to date that European currencies are the best performers globally, but everybody's kind of up. I mean, the rupee is a bit soft, but 9 out of 10 major currencies are kind of on the stronger side. But I think that the market recognizes that there's some very particular aspects to the euro, that the fiscal stimulus, the hopes of a ceasefire in the Ukraine, those are very euro specific. The rest of the world, I think, is looking at the U.S. economy. We always thought that the market was too optimistic on the U.S. for H1. Rates ramped up severely in Q4. The dollar went up, but there was no stimulus coming in Q1. So I think that this kind of soft patch is helping everyone else. And now the market expects, I believe, they have 3.5 cuts priced in. We think that's too much, but it tells you that they're paying attention to soft indicators in the U.S. economy. We don't think the U.S. is going into recession, by the way, but we think the economy will be soft enough for the Fed to cut twice.
Okay, Steve, we'll leave it at that. Thanks so much for taking the time out and being with us and giving us your thoughts. Have a great evening.
You too. Thank you so much.